Alrighty, good morning. October 27th, Monday, 2025. We have a nice inflation number that came out Friday. In the market, well, basically the market was up almost 500 points. Point is only 2. Dow Jones is on the close on Friday. So, we make new high, basically. As you can see in the chart, market new high in this morning, we are indicating that we're going to gap up again. And so, essentially, we are beginning high in a bull market mode. Right now, the Dow is up, the future is up 237. And right now, well, the markets are opening in 1 minute. Yeah. So when the market new highs, I'm looking for selling calls, collecting right on the stocks that already made money. And I'm still holding. I'm selling cover call at minimal, or I'm going to do ratios spread. But let's go dive right into it. Right now, I'm looking at that ball. Question is, when a stock makes new high, how do you determine what strike price you want to sell? Your cover calls. There's a few ways to do it. You can use delta. You can use, which is the probability of that underlying instrument. It's the expiration date of the options. Will it be get exercised? And probability of win-lose is short when you sell that options. You see the market. It's up 300 right now. So that is settled for the morning first. Typically, I trade. See how it trades. But right now, I need to start constructing the strategy. If I just use delta alone, without luck, and what is the QQQ? Delta. Look at this open. I guess the data is not coming through yet. Open delayed. There we go. Okay. Right. So I'm always looking at 45 days now. Around there. So 39 days this up on Feb 2025. 39 days left on the QQQ is the one I will be looking at. Okay. The strike will be 625. So if I short the call, you need to short the call, sell the call, do a cover call. The dollar is 50. 2 calls, 50-50 chance of that. Alright, so I'm gonna go further. Let's go 630. Yeah, delta doesn't change much. Oh, okay, 646. I can go way further. 650. I want a delta to be below 30. 24. Okay, that looks good, but of course, my maximum profit is 449. And so that's if I do the QQQ, but now I'm actually doing my APL. So I'm going to look at 45 days out. The data is not filtering in. If I can do it otherwise, I can look at, go to Yahoo options. Oh, there we go. Good. Again, right away. 45 days out, I'm sure. Around there, right? 39 days, fine. No. It's fine. That's 290. 290. 285. Okay, 285 is an 80% win. 280. 70%. So 280, 285, 290 are the 3 strike price I will be looking at for the 39 days out call options that we're planning to write as a cover call. That means I will own the stock. I need at least 100 shares of this stock. That's what I need. Already owned. And it's already in the money. That means I'm already making profit on underlying stock. Just let's go by the chart. Alright, so we're looking at 280, 285, 290. The second way to do it, we're going to add another probabilistic model. We're going to add another probabilistic model to this. And not just relying on the delta. When you use this Fibonacci numbers, which is a very popular number from a mathematician that is basically looking at normal distributions and fractals and all that. And so I'm gonna look at from the recent, the whole trend, the recent trend from the low to the high, right? Okay, but I'm gonna pull to the first level of Fibonacci right here, which is that. And we'll use that. Okay, I will pull this, and I'm gonna. This is a midline. This is a midline. Yeah, pull it to the red line on this, which represented 0.2236. So, this whole move is like capturing, the last 0.23%. I'm gonna project to that level, and it's 293 when I project whole Fibonacci number onto the top level. Next to the last level. That's what I did. Okay, instead of this, will tell you, right, the trend, this recent trend, cover it with Fibonacci number. I'm going to make projections this way. The red line is on the most recent high, and we'll project upward and give it this probability. And so within this whole move, from the current price point to 293, right, there is another 0.3% probability. You can visualize it that way. Okay? So that coincides with the delta number. So this gives me a comfort level where I want to be. Sell my stock, take profit. While I'm waiting, I'm going to collect rent. So I'm sell cover quote. Right, so 280, 285, 290 at the 3 strike price that I'm going to look at right now. The stock. And this is how I do it. So I go back to the option strategy and look at the delta. I look at the Fibonacci numbers, and that gives me a really quick way to look at. Now, the third way is the fundamental analysis screen. And so what I can also do is, okay, let's look at the APL, right? DCF, discount hedge fund. And now, click on, I let Google focus because I can adjust some of the numbers to be seen. The quick way, like growth, 25, see, 25%. You see how that impact with a very slight that this in that sense. So the growth rates need to be around 25%, right? On the tangible book value for it to reach 370. So that's 22. I'm trying to find out at 290 what should the fair value be? 26, 4, 3, 2, 22, and okay, 23, 24. So I need the 24% growth. That's giving me a ballpark, just to visualize that. Right. Does it have to be exact? No, it doesn't. It just give me an idea, the projection of a growth rate. Right? But that fluctuates all the time. In that sense, I can change it to CF. So if I have forward cash flow doing 24%, number will be different. Okay. So that's one way to look at it. This kind of cash flow, right? Which, fundamental takes 6 to 18 months to play out in actuality. Right? The other way is just using the delta, or again, we're gonna really use the technicals of this. Right? So we can really quick glance, on the fundamentals, on the technicals as to where it is. Now the other two technicals I always also need to see is the MACD. Just away from mature, that's always is still have momentum to grow. In that sense. Also, my moving averages, when I make new highs, way above my shortest state moving average. Now again, the zooming chart is different. Now I'll go to the daily chart to look at my moving average, right? So I can see the long term, near term, right? 13 days, 2 weeks moving average, way above, of course. So ideally I want to buy it at have like discount price, but of course in the bull market, I'm not buying, I'm selling my stock. But what price would I sell it again? Alright. So I use the delta, this Fibonacci number, and I will also use the DCF model. That give me a probabilistic models all combined together to help me determine where I want to put my strike. So right now 280. 280. If it was 280, why is it okay? Short call. There we go. Yeah, we go. Mass profit 375. Then 285, 261, 290. Right. So as you can see, it would change dramatically because my reference is way high, so the profit is much lower. So again, how much probability of it hitting this strike price on expiration, right, that the option get exercised? That's the key part again. So 82% win rate, right? Delta of 20%. That's very comfortable. $250, right? Just hold it for 39 days, literally, and you collect this rent. So 285 strike is my midpoint. What above or lower? And again, depends when I put on this couple call, where is the underlying price? And I will adjust it 21 days before expiration. If the market come back down and collapse, well, then I will close it early because that putting a big getting is very far and I can buy it back at a much lower price and make a nice profit. But if it get closer to my strike line, I will hold it. And if it go through my strike line, I'm just gonna hold the whole thing till the expiration. Yes, that's the 3 scenario that can happen. Right, a couple call. Okay, so I'm not gonna go into the ratio spread of this. I don't want to make too long of a clip at a time right now. I'll go into a separate one when I do a ratio spread. And that's it on our Apple. Then, thanks for watching.